The hyperscaler investments fueling the AI build-out being met, well, with a bit more skepticism. Investor concerns around whether the AI cash burn will actually pay off, actually sparking a rush to actually hedge against hyperscaler bond risk. Take a look at the credit default swaps market, and you can see how some of that anxiety is starting to set in. John Hirtle is a founder and executive chairman over at Hirtle and Company, OCIO firm, who's, of course, tracks a lot of this stuff, John. And one reason why we wanted to talk to you was to kind of get a sense here of the fact that AI has kind of eaten this market for good and bad, whether it's in the equity space and, of course, now in the credit space as well. Talk a little bit about sort of the narrowness that we've seen when it comes to some of these AI investments and whether you think it poses any real risk.
Well, it's not just AI investments. It's actually narrower than that. It was chip investments. So what's really spiked lately was just microchips, which was interesting because all through time they've been viewed as a commodity. And really, we thought that was unsustainable because, when you get excess profits in the market, the real purpose of a free market is to attack those excess markets. So it's not surprising that the semiconductors are kind of rolling over here. As far as the AI names, the superscalers and so forth, the hyperscalers, we're really in the middle of a sea change. So this is hard to call, but it's big. And as investors, we should all be happy that we're participating in it. And so there's a lot of questions about whether we can get an attractive return on investment relative to all this massive amount of capital spend. And only time will tell. But you can see some of the skepticism and some of the questions being reflected in prices lately. And you've seen other sectors outperform those companies that had led the way for so many years.
I understand the skepticism. And just to play devil's advocate here, though, there was a lot of criticism of a lot of these big companies that for years were using this massive cash flow that they had and just basically, buying back stock or in some cases giving dividends. And there was a lot of discussion as to why weren't they reinvesting in their businesses. So take Alphabet. So we got their earnings the other day. Negative free cash flow. I guess on the surface that's bad, but then some people will say, well, that's good. They're investing long term in their business. Whether the payoff actually happens, over the next couple of quarters, should we be as concerned about that? If we do believe in this idea that AI is going to be this sort of transformative thing for our economy and for these companies?
Well, these are terrific companies, and most of them are earning money. So it's not a dot-com bubble where people are paying huge prices for clicks on the screen. These are real companies. They're fantastic companies, but they're not cheap. And so what we're looking at in the marketplace, and by the way, most serious investors have an index core. So if they have that index core, we are exposed to all those names. So the real question is on the margin, what do you do to differ from the index that's going to add value or mitigate risk? And so in that case, you have to look for that incremental decision, which is, are they going to get an attractive ROI relative to other things in the marketplace, relative to companies that are using artificial intelligence to increase their margins? And on the margin, we're starting to see the market say, not so sure.
We have a lot of earnings from these hyperscalers coming up this week. Are we going to see anyone talk about the ROI, or are we going to see what we saw with Alphabet? The company says they're going to spend more. The shareholders sell the stock.
Yeah. Well, the market will tell. In other words, there's wisdom in the markets, and we have to be humble about that. What we're always looking at is when does the wisdom of markets turn into the madness of crowds? And right now, the market is still being fairly rational. So we're looking at those earnings, and we're going to digest them as they come in, and the market will respond. But there's no way to predict exactly what's going to happen there, although the market anticipating that is anticipating it in its price movement. Mm-hmm. So, my sense is that they're going to be hitting their plans. It's not that they're not hitting their plans, it's the plans themselves. It's almost like everybody going into the market can't win, and they're all spending as if they're going to. So at some point, there may be a reconciling or a rationalization on who actually gets the return on equity.
We started the segment showing this chart of, hedging for these hyperscaler credits moving up very recently. But when you look at the broader corporate credit market, everything still looks pretty tame. Do you expect there to be contagion, that the fear in hyperscalers is actually going to trickle into, broader fears about what's going to happen with corporate credit lending, especially if rates get higher from here?
Well, it's interesting, when you think that's a bigger question, and where are rates? And so right now, rates are relatively high. Real rates, if you look at the break-even inflation rate, it's about 220, and the 10 years at about a 460. So that's a 2.4% real return, which is high. Stocks are at 20 times earnings. I hate to get too technical with the numbers here, but that means that bonds are bonds are cheap relative to stocks. So one of the two things is going to happen. Stocks are going to come down in price, or bonds are going to go up in price, meaning bonds, the interest rates would drop. So that's going to flow through the whole credit market. And we don't know which of those is going to happen. We tend to be long duration, which means that we think interest rates are likely to come down. But as a OCIO, as a chief investment officer, we're managing across all these asset classes. And so we have to take all those factors into consideration. You can't really predict this stuff with precision. And the job of serious investors is to succeed, not win this quarter, not call what's going to win this month, but to succeed over the next 5 and 10 years. And the way you do that is by buying these most attractive cash flows, and by being humble in the marketplace to say the market is appreciating the fact that we have a sea change with AI. And that's fully reflected in the market. And having an index core means that we're participating in that. And on the margin, we want to pursue the trends that I just mentioned.
Just on the rate side, we only have about a minute left, John. But I mean, when you look at real yields and kind of what it is maybe signaling, and against the backdrop, at least over the last couple of weeks, where people have started to speculate that the Fed's direction might be to hike, given some of the inflationary pressures out there. Are you in this camp that the Fed would actually want to and actually be able to hike? Or are you in this camp that we will see rates start to come down and the bond rally that a lot of people are banking on start to take hold?
Well, we don't like to forecast things like that. I'm struck by first of all, Romaine, that's a great question, and it's good to see you again. I forgot to tell you that when I first signed on, so nice to see you.
Likewise.
Anyway, it's a great question. The point is that John Maynard Keynes says there's two types of forecasters in the world: those who don't know, and those who don't know they don't know. Yeah. And so, you can prognosticate, but we'd rather prepare. And so on relative valuation, real rates are relatively high and stocks are relatively expensive. So on the margin, we want to move away from the most expensive stocks and buy bonds, long duration, because the real yields are high. Not because we're predicting that they're going to change, but because today the real cash yield on a bond is attractively priced.
John.
All right. Our thanks to John Hirtle, founder
Thanks, Emily.
and executive chairman at Hirtle & Co. Now let's take a look at some other